In 2024, the global silver market ran a deficit of over 200 million ounces. Not a crash, not a panic, just a quiet shortfall, barely noticed. Yet this number matters more than most people realize, because deficits do not disappear, they accumulate, like pressure behind a wall, and walls do not warn before they fail. Silver is not rare in the way gold is rare. It is rare in a more dangerous way. It is essential. Every smartphone, every solar panel, every data center, every missile guidance system uses silver. Unlike gold, nearly all silver is consumed, burned into circuits, lost in landfills, gone forever. When demand exceeds supply, there is no vault to open quietly. The hidden concept is simple. A market can survive imbalance for years, until it suddenly cannot. Silver has been running structural deficits for most of the last decade. In the 1990s, the world mined more silver than it used. Today, it uses far more than it mines. Recycling fills part of the gap. Stockpiles fill the rest, but stockpiles are finite. Once they thin out, the math changes fast. History has seen this before, not with silver alone, but with strategic resources tied to monetary systems. In ancient Rome, silver denarius coins were slowly debased. The metal content shrank year by year. Trade did not stop immediately. Soldiers were still paid. Markets still opened. Then, one day, prices doubled. Trust cracked, and the empire never recovered its footing. In 16th century Spain, silver flooded in from the New World. For a time, it made Spain look invincible, but the abundance masked deeper decay. When supply chains broke and silver shipments slowed, the economy seized. Inflation spiked, debt suffocated the crown. The empire collapsed, not when silver vanished, but when confidence in it did. Patterns repeat quietly. Silver demand grows about 2% per year. Solar alone now consumes over 140 million ounces annually. Military and electronics add tens of millions more. Meanwhile, global mine supply has stagnated. It peaked around 2016. Since then, grades have fallen. Costs have risen. New discoveries are scarce. Mining is slow. A decade from discovery to production is normal. The numbers reveal the imbalance. Global silver demand sits near 1.2 billion ounces per year. Mine supply struggles to reach 1 billion. Recycling adds roughly 180 million. The gap remains year after year. A 200 million ounce deficit is not a headline. It is an erosion, like removing a brick every day from a load-bearing wall. Compare this to inventories. Known above ground, silver bullion is estimated under 4 billion ounces. Much of it is locked in industrial form. Not bars, not coins. Once melted into devices, it does not come back. At current deficit rates, that cushion shrinks faster than most models assume, especially when demand accelerates suddenly. Now look at the present signals. Governments are pushing electrification. Green transitions are silver intensive. Solar capacity targets imply demand doubling within 10 years. At the same time, interest rates pressure miners, capital dries up, environmental rules tighten, supply responds slowly, if at all. This is not speculation. It is arithmetic. Markets tend to ignore slow crises. Prices stay calm until inventories hit a threshold. Then price is no longer a signal. It becomes a rationing mechanism. In the 1970s, oil did the same. Shortages appeared first in spreadsheets, then at gas stations. Silver's shortages still mostly invisible, for now. The consequences will not arrive with sirens. Manufacturers will face delays. Governments will prioritize defense contracts. Retail investors will be blamed for volatility they did not cause. And quietly, contracts will settle in cash instead of metal. When that happens, the system has already admitted scarcity. For individuals, the impact feels indirect at first. Electronics cost more, energy projects stall. Currency purchasing power erodes as hard inputs reprice. Silver has always been a monetary mirror. It reflects stress before people understand why. When it moves, it is usually late, not early. The unsettling part is this. A 200 million ounce deficit is not an accident. It persists because the system tolerates it, until it cannot. When inventory is finally thin enough, there will be no policy lever left to pull, only repricing. And the reprice never asks permission, because the most dangerous shortages are the ones hidden in plain sight. And the silver market is already whispering that the visible deficit is not the real one. What makes this moment different is leverage. Paper claims on silver outnumber physical ounces by estimates of 50 to 1. Futures, options, ETFs, swaps, promises stacked on promises. This structure works only if few demand delivery. History shows this always holds until it doesn't. In 1968, the London gold pool collapsed the same way. Not from panic, from quiet withdrawals. Central banks understand this dynamic. They do not publish silver reserves. They do not discuss industrial shortages. Silence is policy. Because once scarcity becomes common knowledge, control evaporates. The hourglass flips, and everyone reaches for the same narrowing exit. The clock is not measured in days, it is measured in inventories. Each year of deficit drains optionality. Each new solar mandate accelerates the drawdown. Each delayed mine removes future supply that cannot be replaced quickly. The system is betting that demand growth slows before stockpiles run thin. That bet has failed before. When pressure valves fail, the release is sudden. Prices gap, contracts break, trust vanishes. The public is told it was unforeseeable, but the numbers were always there. They were just boring until they weren't. And somewhere beneath today's calm charts and stable prices, the silver deficit is still widening. Quietly, patiently, waiting for the moment when arithmetic overwhelms belief. Because when a market runs out of metal, it does not negotiate. It reveals what was hidden all along, and the next reveal is closer than it appears. What happens next will not be announced, debated, or voted on, because shortages obey physics, not narratives, and physics always collects its debt, eventually silently. The second half of the story begins where markets stop talking and start adjusting behavior. Not publicly, quietly. Silver is not rationed by law yet. It is rationed by priority. Defense first, energy second, consumer last. This hierarchy already exists. It is just not advertised. When shortages deepen, contracts change language. Delivery windows stretch, penalty clauses appear. Cash settlement becomes easier than metal settlement. This is how scarcity is normalized without headlines. In 2021, several industrial buyers reported waiting months for refined silver. Prices barely moved, that is the tell. Shortages that do not move price are the most dangerous kind. History warns what comes next. In Weimar Germany, paper marks circulated long after silver coins vanished. The public noticed only when prices detached from wages completely. In 1971, when the United States closed the gold window, the announcement came on a Sunday night. The decision had already been made. The system did not break that day. It revealed that it had been broken for years. Repeating patterns always involve denial first. Analysts point to substitution, thrifting, efficiency. All real, but limited. Silver is the most conductive metal known. There is no perfect replacement. Copper loses efficiency. Aluminum corrodes. Substitution reduces demand growth. It does not reverse it. And each efficiency gain is already priced into forecasts that still show deficits. The comparison that matters is time. At current rates, new silver mines replace less than half of depletion and demand growth. Even optimistic projections show deficits persisting through the next decade. This means every year, forward consumes future flexibility, like spending tomorrow's savings to pay today's bills. Now add debt. Global debt exceeds $300 trillion. Monetary systems depend on confidence and abstraction. Silver is not abstract. It is physical. It is one of the few assets that sits between money and industry. When monetary trust erodes, silver demand rises from investors. When industrial demand rises, investment supply tightens. This feedback loop has triggered every major silver spike in history. And look at 1980. Inflation surged. Geopolitical stress rose. Investment demand exploded. Silver went from $6 to nearly $50 in months. That move was not about speculation. It was about shortage meeting fear. Inventories vanished. Exchanges changed rules midstream. Prices collapsed afterward. But the lesson remained. Silver moves last and fast. Today's setup is quieter but broader. Solar demand did not exist in 1980. Data centers did not exist. Electric vehicles were irrelevant. Now they are central. Each one embeds silver invisibly, millions of tiny drains on a finite pool. No single project causes crisis. All of them together do. The silent consequence is repricing of reality. When silver prices rise sharply, it is not silver becoming expensive. It is currencies becoming weak against a real constraint. This distinction matters because policy responses target symptoms, not causes. Price controls, strategic releases, verbal reassurances. None create metal. For individuals, the personal impact arrives asymmetrically. Most will not own silver. They will feel it through higher costs and slower infrastructure, through shortages framed as logistics issues, through inflation blamed on external shocks. Very few will connect it to a structural metal deficit that began years earlier. This is how engineered inevitability works. Not through conspiracy, but through incentives. No single actor intends collapse. Each responds rationally to local pressures. Miners cut exploration. Governments mandate electrification. Investors chase yield elsewhere. Together, they create a system that consumes its own foundation. At some point, one large buyer will refuse cash settlement. One nation will prioritize stockpiling. One exchange will quietly alter delivery terms. These are not dramatic events. They are signals. And signals cluster before breaks. The cliffhanger is not price, it is trust. When participants realize that silver claims vastly exceed silver itself, behavior changes overnight. The question shifts from price to possession. And that shift has ended systems before, because the most dangerous phase is not when shortages are obvious. It is when they are almost obvious. When insiders act and outsiders are still calm, when charts look stable and warehouses empty faster than reported, the silver deficit is no longer a forecast. It is a condition, and conditions eventually force decisions. Decisions reveal priorities. Priorities reveal who bears the cost. What remains hidden is how close inventories are to the line where promises fail. That data is opaque by design, but history suggests the reveal is never gradual. It arrives in one sudden adjustment that everyone insists no one could have predicted. Yet the math was always there, 200 million ounces per year, every year, compounding, silent, relentless. And when the adjustment comes, it will not ask whether you were watching. It will only ask whether you understood what the silence meant. The worst part is not what has happened, it's what is still unfolding. Every day you ignore the numbers, the deficit grows, the invisible pressure builds. Silver is already scarce, the system is already stretched, and the moment when reality finally bites is closer than anyone wants to admit. Stop now, and you will have missed the signal that could have saved you. Watch carefully, because what comes next will change everything. And once it starts, there is no turning back.